Welcome to the Stock Play of the Day Overtime. On Monday's Stock Play of the Day, we talked about using options as portfolio protection. We looked at four different scenarios going into the election. Today, we'll discuss how did those scenarios play out. Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Monday's Stock Play of the Day, that was obviously a very important Monday in that it was the Monday before the November 3rd election. And we just looked at four different scenarios that you might have had in your head or in your investing strategy going into the election. And I'm just going to outline those scenarios that we were talking about here. First of all, we said, some people might have thought, I'm out, too much risk. I'm just going to wait to see what happens with the election. A lot of those people might have been considered swing traders, people that are actively trading their portfolio. They just get out of that position and they're gone. The next one is, I'm out, but I'm nervous about the upside. In other words, I've sold all my stocks or a good portion of them, generated some cash, but what if after the election the market actually goes up, like which has actually happened recently? Pretty good rally to the upside. The other one would be, well, I'm going to still stay in, but I'm nervous about the downside. And that was another scenario that we looked at, saying that, well, I want some protection for my stocks, but I would like to hedge them on in its entirety, as opposed to just buying individual protection on each and every stock that I owned. And then lastly, I'm just going to ride the wave. In other words, I'm looking at this. I'm just going to stay I'm in this for the long haul. Any waves that might come after this election, I'm just going to let them play out, and I'm going to see where my portfolio ends, and I'll keep investing, maybe dollar cost averaging as we go into the end of the year. Okay. So with that said, the two scenarios that we really talked about mostly on Monday is that I've sold my positions. How can I protect myself against a big upward move like we recently had, actually, since Monday? And I'm sure everybody's been in the news and knows what's going on with the election. So what we'll just focus on here was, well, what happened with the VIX index and to the volatility of the marketplace as a whole? I'm highlighting my VIX watch list here right now. We currently see that the SPX is up just a little bit today relative to the last few days. It's kind of settled down a little bit, but it's still to the upside. We got the VIX trading at 26% implied volatility. Now, that was at 37% on Monday. So we had a precipitous drop in the spot value of the VIX index. The November VIX futures contract, this contract will expire on the 18th of November, actually is down to 26% implied volatility. But interesting to note that as we go out to December and February and January, December in this year, and then January and February in the next year, they're still up around 20% implied, 27% implied volatility. The only thing that is interesting to note to me on those numbers is that we've came down on the actual volatility recently, the actual spot VIX index, but we still see that the marketplace anticipates, even going out into the new year, and a VIX index above the 25% level. So the marketplace doesn't think this volatility is going away anytime soon. Obviously, we had a few big down days that increased the anxiety of all of the investors in the marketplace. And then once all of a sudden, it seems like when the news came out, that anxiety came down and that election actually started, we saw the VIX actually dropping off precipitously, the actual VIX index. And then we've seen that November futures contract come down also. So what has happened? Let's look at a chart of the S&P 500 index since Monday. Now, this is a 15-minute chart, and we always tape the stock play of the day on Monday at noon Eastern time. The markets are live, just like they are right now. And this is where Monday was. So on a 15-minute chart, this is all day Monday. Market traded a little bit down. And then on Tuesday, up, all the way to Friday. Now we're a little bit more flat on this Friday today and a little bit more tamed movement in the marketplace overall. As a matter of fact, even if we just kind of highlight the lows to the highs each day, we had fairly wide swings, mainly to the upside since the election voting took place. Obviously, we don't have a winner as of today, as the taping of the show. There hasn't been one that's been proclaimed. All right. So what did we look at? Well, the first scenario that we were talking about was just buying a call option on your portfolio using the SPY. If you were doing that, that means that the stocks that were in your portfolio, or basically your outlook, would be that you owned more stocks in the S&P 500 index. We sold them all. That's what the premise was. How could I protect myself against the upside? And we came in and said, well, if you're doing the math here and you are buying one call option, and the SPY at the time that we were looking at this trade on that Monday, the SPY was trading at 330.40. I forgot a zero on my note here. 330.40. We looked at just protecting ourselves through the election, mainly because if you go up further in time, it becomes pretty pricey because that implied volatility was so high. So we just looked at the November election, and November 6th was the expiration date. We ended up paying for that option contract the 330 strike call, which was 1% out of the money when we're looking at doing that. That call option for every $3,330 of portfolio value, we would have bought one call option for each that amount of market value, right? So one call option should have protected us to the upside for that approximate market value. And we did emphasize that it's not going to be exactly like your portfolio would be. That's not the way insurance works overall, but it would give you some protection against an upward movement. And that option contract was trading for $5. The market has moved up quite a bit. Obviously, it's at 350.27 now. So this option contract is now trading for 1738. So I'm just going to put this over here in the right rail. And the way that we would close out this position, if you wanted to, is you would put sell to close in this scenario, and you try to work it, maybe sell it at around 17, we'll call it 40. Let's just make the math simple, and enter that as a day order. You click preview order, and you would send that order down to the trading floor. That's how you would close out this position. Now, if you had a portfolio of stocks and you were protecting yourself, we looked at a larger scenario. We talked about the S&P 500 index, the SPX. Now that is right now trading up 47 cents, so it's pretty much flat. It's actually came down since we started our video here. $3,511. We look to go about 3% down, and understanding that if we did this trade here, and for every put that we bought, that would represent, when we put on that trade, approximately $330,000 of market value. Okay, so that would be one put, and that's because of the value of the index. You take that value, multiply it by 100. That would be the concept. Now, once again, you have a deductible, just like you would on most car insurance. That deductible was from where the market was at when we did that trade. So when we looked at the SPX, it was $3,310 thereabouts, and we bought the 3,200 strike put. That was about 3.3% below where the market was at, or about 110 points. We paid $3,100 for that put. It was trading for $31 at that point in time. Now, that's an approximation on market value. If you had a $300,000 portfolio, you could have bought one put. You could have bought some more SPYs if you wanted to. If you had less of that in that scenario, you could have bought two of them to try to protect yourself. Bottom line is, you have to just kind of understand the basis of using options, it's specifically index options or ETFs that track indexes as put protection for your portfolio. How do you set up that trade? What's the quick and easy math to look at setting up that portfolio? Well, obviously that option contract is zero right now. I'm kind of highlighting it here. So there's really nothing to sell. You would just let that option expire worthless, and you would honestly be happy about this trade. And I want to emphasize that. If you bought this option contract as protection, you're better off than the person that bought that SPY to protect against the upside. Why is that? You stayed in your portfolio. You had all your stocks. Your stocks should have went up, and this option contract should have provided you that protection. It's the same concept of buying insurance on your car. You don't hope you crash it into the tree over the term of the policy, right? You want your car to stay intact. And that's what the goal was here by using index options as a portfolio protection on the stocks that you currently hold in your portfolio. So scenario 2 here said that we stayed in the market, we protected ourselves. Now, obviously, the best scenario was scenario 4, where you just said, I'm just going to ride the wave. I have all my stocks in place. I dollar cost average. I have a long-term outlook. Because if you did that, you didn't spend any money on insurance, and you actually had a good, strong move to the upside overall. All right. Well, that's it for this episode of the Stock Play of the Day Overtime Edition. We'll be back this Monday for Monday Stock Play of the Day. We tape at noon Eastern time every Monday, and it is live. So you want to make sure you click subscribe and ring the bell so you get all the notifications. Thanks for coming, everyone.